Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. Overall, I think Q1 was quite misleading. Tesla had a great quarter, but they did this without the Model S and X sales. Although it's great to see that the company can survive and profit very well without the Model S and X, I think the company is being valued the same it was the previous quarter, despite an absolutely incredible jump in Model 3 and Y sales. So I wanted to analyze just how valuable Tesla is now, without speculating on Texas and Berlin, 4680 batteries, FSD, or robotaxis, because I think Tesla may have blown Q1 completely out of the water. In order to do this, I want to remove all the costs associated with growth, or that are temporary, that are affecting the business, like stock-based compensation, and I just wanted to extract only the auto business and put a valuation on what it's worth today. Well, I say today, but what I really mean is the resources that Tesla have at their disposal today when they're at their potential, using only technology that has been proven. I guess, in other words, how much is Tesla worth with just Fremont and Shanghai factories? This would imply we have the Model S and X lines fully functional, we have Model Y Fremont ramped up, and we have Model 3 and Model Y Shanghai ramped up. What is that business alone worth? I don't want to say where they'll be in Q4 or anything like that. It's more what they are capable of doing now with the given resources and capacity, assuming all components are available. We aren't even going to include the Giga press being used for any new models either. No more capital expenditure in that regard. Well, let's get to the numbers. How many cars can Tesla produce from Shanghai and Fremont in a quarter? On the earnings call, Elon said that the new S and X lines should be upwards of 2,500 a week. With an average of 13 weeks a quarter, that comes to a total of 32,500 Model S and X's a quarter. The Model 3 in Fremont is likely just over 50,000 models currently. I think we can comfortably take this number to 55,000. Now that's 220,000 Model 3s a year, and we're told Tesla has a capacity of 500,000 in Fremont, which would leave us with 280,000 Model Ys, or 70,000 a quarter. Now, I estimated that Tesla was still doing around 48,000 Model Ys from Fremont in Q1. Essentially, this is a massive increase. But Elon said on the earnings call that they're still ramping up Model Y at Fremont, which I thought was a big deal, and I was very happy to hear that. And yes, everyone, I'm aware that 500,000 is the capacity, and there is downtime and things go wrong, but that capacity was claimed before a lot of other efficiencies have been calculated, and Elon has also said Fremont is capable of 1 million cars a year. In addition to that, Shanghai has already exceeded their alleged capacity, so if anything, this may even be more on the conservative side, but either way, it's using deductive reasoning to come to a figure we can use in our model. Okay, moving on to Shanghai. Shanghai has a capacity of 200,000 Model Ys and 250,000 for Model 3s, so that's very simple to calculate, except for the fact that in March, Tesla did 25,327 Model 3s, and it's not the first time they've hit these sorts of numbers in Shanghai. Now, last time I checked, they were 12 months a year, and I checked just 2 hours ago. So if I multiply March's numbers by 12, that comes to 303,924. That's 20% above the alleged capacity. But okay, let's just stick with 25,000 Shanghai Model 3s a month, or 75,000 a quarter. The Model Y is still ramping up, and since the capacity was announced, Tesla have brought in the likes of the Giga press and other manufacturing advances, not to mention the other continual improvements we never hear about. Let's say that the actual capacity is therefore 20% higher, same as the Model 3 factory, and is 240,000 Model Ys a year, or 60,000 a quarter. I've then created a table for the average selling price of the cars, adjusted to resemble closer to the last quarter. In fact, the way I adjusted these, it matches up perfectly with the Q1 financials. So I think it's a very likely average selling price. But this actually only helps to calculate the Model 3 average selling prices from last quarter. This gives us average Model 3 price of 43,000 for Fremont and 42,700 for Shanghai. For most of Q1, the standard range Model Y was available, therefore we have to adjust the average Y price accordingly due to the standard range costing less, not using numbers from Q1, as Tesla have somewhat discontinued the standard range. Our adjusted price gives us an average selling price for the Model Y of $52,000 from Fremont and $53,000 from Shanghai. For the S and X, I think the Plaid editions will actually be very popular just due to the fact of how utterly outstanding they are. I think $100,000 really could be a likely average selling price, which would probably be around 40% of consumers purchasing Plaid over the long-range versions. I'm happy with my FSD model for adoption rate and deferred profits for the cars that I've used for my Q1 estimates. As you can see, FSD isn't a huge moneymaker yet, but it's software they're selling, so it's basically 100% profit. When we total those up, we have $15.8 billion of auto revenue. To give you a comparison, we were at $8.5 billion in Q1 and $8.9 billion in Q4. Are you starting to see it now? That's a huge difference. This is what Q1 told us. If you read between the lines and get deep enough into the weeds, there is a lot more being said when you avoid the distractions. This isn't too far off twice the revenue of Q1. All these numbers still exclude tax credits. Now we need to estimate what margin we're dealing with without tax credits. If we remove the credits, then we have Tesla at 22% margin for Q1. However, we had Tesla at 24% margin in Q3 2020. Margins should have significantly increased since Q3. Then what's keeping the reported margins so low? Well, a lot of other costs go into the cost of goods sold figure. Items like the S and X line upgrade. They've run into supply chain issues which added costs. I think they're even including the Giga presses in there too. I.e., I think Tesla are doing a bit of creative accounting to try and make their margins look worse than they actually are. The S and X clearly do have an impact though, but we should expect these new refreshes to have reduced production costs whilst raising prices significantly for the Plaid models. Oh yeah, and we're not going to include the Plaid Plus in this modelling, as that would require the 4680 batteries. In other words, the S and X should have an impact on margins, and if we removed all these other associated costs, and perhaps allow Tesla to include a few other efficiencies, then I think this figure really should be at 28% excluding credits. Bear in mind, Elon has also said that they could redo the lines at Fremont and upgrade the manufacturing process that would improve margins, but the downtime is not feasible currently. If I recall, this was on the latest Joe Rogan podcast. Alright, using those margins, we come in at a gross profit of nearly $4.5 billion. In case you didn't know, that's huge. I can't see regulatory credits going anywhere anytime soon. In fact, I think this side of the business will likely improve. And although it's not a tangible product Tesla are manufacturing and selling, it's still a service they're supplying to their competitors that are willing to pay for it. So I don't think people should be so quick to discount it. They say it's not something that Tesla can depend on, and there is some truth to that, as it's not really in Tesla's control so much. But if anything, they're likely to increase and keep going until the ICE manufacturers paying for them go under, or unlikely transition to EVs. However, I think we could value the business with credits and without credits, although credits will continue to rise. And it really is an enormous amount of capital for the company. Unbelievable, really. Let's stick with Q1 numbers at $518 million for credits, which brings the gross profit to $5 billion. Then what about other costs? We're removing a lot of associated costs, which is what I've been trying to explain in my previous videos. These associated costs look like they're impacting Tesla's profit significantly currently, but they're used for growth mainly. And as soon as Tesla can really break out of their auto business, these costs will become relatively smaller, and the profits will double or triple where they are currently, and soon too. Anyway, in this scenario, we're not going to factor in a lot of the costs for this reason. And the energy side of the business is actually a major cost, as it makes continual losses every quarter. But in this scenario, we're removing this element of the business. The servicing side of the business is also a loss, although somewhat smaller, but this will actually end up being profitable as more cars run out of warranty. But let's just have the services side as break even for now. It's not a large part of it anyway. Okay, what about actual costs then? I'm going to remove depreciation and amortization. The equipment has been paid for. We don't need to keep paying for it each quarter. It's just there for accounting purposes. There will of course be maintenance and equipment replacement, but the vast majority of capital has already been paid. Yes, I'm keeping it a bit on the simple side perhaps, but let's just see where this is headed. Research and development was $666 million last quarter, mainly attributable to the 4680 batteries and structural battery pack. But it usually hovers around the $300 million mark, but we're excluding the growth of the FSD business and the 4680 batteries and essentially any other future endeavors. We're trying to calculate what Tesla is worth now with what they already have, not based on any future value. In other words, I'm going to reduce the R&D value to only $100 million a quarter. Same with selling general admin. This was over $1 billion in Q1, mainly due to expansion in China. But I think in our scenario, Tesla could cope with just $500 million a quarter. Without looking at growth, we can offset some of the debt with the cash they have on hand. And let's say Tesla can get by on $50 million a quarter for interest expenses. This equates to an EBITDA of $3.8 billion, although it's not quite EBITDA as we have included the interest, or $4.3 billion including credits. If we have tax at 21%, although that tax rate will likely soon increase, as after monetary policy comes fiscal policy. In other words, someone has to pay for all the government spending, but it's more apt to keep with the current tax rates for valuation purposes. But that translates to a net income of $3 billion a quarter, or $3.5 billion with credits. In other words, $12 billion and $14 billion annually. At Tesla's current stock price, that gives the company a PE ratio of 57 and 49 accordingly. And people are complaining about PE ratios in excess of 700. But when you tidy things up, a PE ratio of 50 is only about 3 times Toyota's. Of course, this would be if Tesla cash cowed the entire company and totally wrote off their energy business and even the AI business. It would be as if they wrote off Texas and Berlin. You know, those factories rumored to do 2 or 3 times as many units as in this model's predicting. In this scenario, the 4680 batteries might as well have been a total lost cause and turned out to be a fool's errand. It would mean that the feature-complete FSD never came into fruition, let alone any robotaxis. It completely discounts the Model 2, you know, the best-selling car of all time. Of course, it also means there'll be no Cybertruck, Semi-Truck, Roadster, or any other future models either. Of course, it also means there are no future factories anywhere. It would imply they weren't able to make enough batteries for energy storage and gave up on solar. In other words, all these things I've just mentioned add tremendous value and is what the entire company is working at achieving. But even without them, Tesla is still a very profitable company. What if we started to add some of those back in though? Texas and Berlin alone each doing 1 million units a year. Well, then we would have a gross profit at around a whopping $13 billion a quarter then. What if Model 2 started selling 2 million units a year? Then we're around 16.5 billion. What if 4680 batteries, Giga structural battery pack, improved margins, an additional 5% from 28% to 33%? Then we're at a gross margin of 19.4 billion. What if there was finally enough batteries to really grow the energy business and make a decent profit? Then we might see $25 billion gross profit. And this is all within the next 2 to 3 years, without any of the AI side of the business added. What? We're at $100 billion gross profit already, annually. Now, those $2 billion a year regulatory credits are starting to look quite negligible. Hence, they are not an important part of the business, but a godsend in capital to provide growth for the business at this stage. So that $12 billion net profit a year we calculated in this model now comes closer to $50 billion when you add everything back in. That PE ratio of 50 at current stock price looks closer to 10. This is why we hodl our Tesla shares. This is why we try not to sweat over the day-to-day stuff, the stock price fluctuations, the dips, because nothing the stock does matters at this stage until Tesla starts to grow, and it's exponential growth from here. This is why we value it as a growth company and have accepted PE ratios in excess of 1,000, because that's what it is. But when you cut back all the growth side of the business and value it intrinsically, in my opinion, a PE ratio of 50 is not at all outrageous. In fact, considering what's coming, it looks pretty amazing. The entire business is positioned for growth. I think this quarter was underlooked, as were some of the details from the earnings call. This is usually how it goes. It takes a little while for people to put all the pieces together in order to work out exactly just what has happened. But one thing's for sure, I'm not selling anytime soon. Thanks for listening. Please hit the thumbs up and don't forget to subscribe.